All right, jumping right in here. The question is, are DST investments safe? And the answer is no, absolutely not. DST investments are not safe. They are investments in real estate, and all real estate has no guarantees for cash flow, distributions, and or appreciation, as well as property values in real estate can go up and property values in real estate can go down. So DST investments are not safe as they are investments in real estate. And investors, we encourage each one to read each DST investment's private placement memorandum for a full discussion of the risk factors of investing prior to making any investing decisions. So the PPM really digs into the business plan and the risk factors so you can understand, what are you getting into? What are the ramifications of an investment? If it goes well, what does that look like? If it goes not so well, what does that look like? And it's important for investors to really understand that these DST investments are not safe. So at K Properties, we've helped thousands of 1031 exchange investors exchange into Delaware statutory trust investments for many, many, many years. Personally, my first exposure to DSTs was in 2007 as an analyst, a real estate analyst in 2007. Prior to that, I was in a commercial real estate large national commercial real estate brokers. But 2007 was when I started working with DSTs. And it was in 2008 that I personally invested in a DST myself for my own portfolio. That was my first exposure. Many, years have gone by since then. We've helped thousands of investors complete their 1031 exchange investments. I've personally invested in over 50 different DST offerings from multiple different DST sponsor companies, multiple different asset classes, multiple different, locations. And so I have an investment thesis of what I believe makes a lot of sense for myself personally, as well as for our investors at K Properties. And when you're working with us, you're going to get that breadth of experience passed on to you. You're going to be able to see how we see things, how we see the world. We've been told by investors that's something that they really appreciate because a lot of people that are selling DSTs now, or a lot of the sponsors doing DSTs, um, you know, they might have all the right things to say, but guess what? They just started working with DSTs 1, 2, maybe 3 years ago. And so, our first exposure was 2007 with DSTs, and then personally investing 2008. A lot of the people that are, sponsoring DSTs or selling DSTs, they've never invested in one themselves. Okay, so we eat our own cooking. We have done this. You're not a guinea pig at K Properties. And so a couple of things that we've put together for investors that are wanting to lower the risk associated with investing in DSTs, and that's considering the fact that all real estate and DST investments are never considered to be safe. They're just not safe. It's real estate. Here are a few things that we believe you should consider. So number one, first and foremost, to go debt free. Debt-free DST investments are considered lower risk as they have no possibility for a lender foreclosure. That's one of the things that has really gotten a lot of DST sponsor companies into trouble is the overuse of leverage. And there's been DST sponsors that have been foreclosed on. They've had to sell properties early at a loss because their loans were coming due. We just saw it just the other day with one of the major DST sponsor companies whereby, they're selling properties early because there's loans coming due. And, you can't blame them. Nobody knew what was going to happen 10 years ago when they put that property out. But at the end of the day, if the property had been debt free, they wouldn't have had to sell into a rising interest rate environment in the midst of all this economic uncertainty and turmoil. So being debt free is really, really, really important. So again, debt free DSTs are considered lower risk because they have no possibility for a lender foreclosure. Number two, how do you lower risk potential in DSTs, considering the fact that DST investments are not safe? They are investment in real estate. And number two is avoid the higher risk DST investments. And what does that mean? Well, there's some DSTs that we consider to be lower risk, and others that we consider to be higher risk. And it's not just us; it's the market in general. The higher risk DST asset classes, if you were to go and want to go buy one of these assets for 10, 20, 50, $100 million. If you want to go buy an industrial property or just a market rate multifamily property, you're going to be at a lower potential cap rate on that acquisition than if you bought into one of these higher risk asset classes. So hotels and hospitality DSTs, senior care DSTs, student housing DSTs, they're higher risk. And again, it's not just us at K Properties that think that. It's we've seen sponsors really struggle as they've put out those offerings, and it's hurt investors. And so at K Properties, we don't work with any of those asset classes. No hotels, no senior care, no student housing. We're constantly being approached by DST sponsor companies that have those type of properties, and we say, hey, your deal might be really great and looks good from the surface, but it's just the risk is not something that we're willing to take on for our investors. And so we don't offer those. Now, again, it's not just our position. If you go and buy these properties in the open market, your typical acquisition cap rate in general will be at a higher amount than one of these kind of core industrial, multifamily, net lease type product types or asset classes. And so the market has deemed these hotels and senior care and student housing to be higher risk, and that's why they trade at higher cap rates. And so the problem there is that you could potentially get higher cash flows when you're doing a hotel or a senior care or student housing, and investors are attracted to that. But the risk to investor equity, we believe, just does not make sense. It's not a risk-adjusted return to investors, and therefore we as a firm have passed on it. Again, the offering might be fine. It might be a DST investment that does really well and the sponsor does really well. We're not saying that the sponsor that's offering it is a bad group or, it's a bad property. It's just the risk profile just doesn't make sense with what our investors are looking for. And, fast forward, we've been doing this for a long, long time, helped thousands of investors. We've seen these sponsors, we've seen them lose millions of dollars on these types of high risk DST investments like hotels, senior care, and student housing. So if you're wanting to lower your risk potential when investing in DSTs because you understand that DST investments are not safe, they're investment in real estate, don't invest in these higher risk asset classes. And then lastly, number 3, utilize a specialist. So it's similar to choosing a specialty orthopedic surgeon for your knee surgery instead of going to your general practice doctor and saying, hey, I need a knee surgery. And your GP just jumps in there and does the surgery with really no experience. That's a similar thing with DSTs. Don't invest in DSTs with somebody that does not have years of experience working with DSTs. We often see financial advisors that don't know much at all about DSTs and or 1031 exchanges trying to sell DSTs to their clients and giving them, quite frankly, terrible advice. And, again, that's why so many thousands of investors throughout the country have looked to K Properties for specialized advice on their 1031 exchange into DST properties because of us working with this type of investment, these DSTs, for so many years, because of our personal experience investing. Like I said, over 50 different DST investments in my personal portfolio. So utilizing a specialist is a way to potentially lower risk. So with that, appreciate everybody jumping in here. And remember, DSTs, they do contain risk. Read the private placement memorandum, read the PPM, understand the business plan and the risk factors prior to proceeding with an investment.
Make sure to visit kpi1031.com and you'll be able to log in for free access to our listings of 1031 Exchange Delaware Statutory Trust properties. You'll also be able to get several other different resources available to our investors on 1031 exchanges at kpi1031.com. You'll get a free book on 1031 DST properties that will send you a free subscription to the 1031 DST Digest magazine. It has all kinds of case studies, tenant overviews, educational resources, and articles in the 1031 DST Digest. And you'll get access to free 1031 exchange educational conference calls that we host every week with our investors on various topics regarding 1031 exchanges, asset classes, financing, debt-free DSTs, zero coupon offerings, different strategies to use when thinking about a 1031 exchange into DST properties. Our team is here to help. We've done a lot of these Delaware Statutory Trust transactions, and have helped thousands of investors nationwide complete 1031 exchanges into Delaware statutory trust properties. We're here for you. Just reach out to us anytime at kpi1031.com. And as always, feel free to call or email me anytime.